whether it is in fact time to get more bullish on these markets, as Altimeter's Brad Gerstner told us earlier today. You will hear his reasons why in just a moment. Let's now welcome in Ellen Zentner of Morgan Stanley and Schwab's Kevin Gordon, both as you see here with us at Post 9. It's great to have you both.
Hi, Scott.
Ellen, you say there is a bull case for stocks, but it's plausible, not probable. Why?
Yeah, of course. Well, I think that April 8th started a new bull market, right? Up 20%. And I think markets are going to struggle for a narrative to hang on to here. I don't think we're past the trade uncertainty. I don't think we've gotten any more certainty, period, on anything, whether how much inflation is still to come, labor market weakness is still to come, uncertainty over whether the Fed will cut this year or not. And so I just don't think there's a whole lot to drive that bull market narrative further.
You also think the bar is high?
Yeah, I think it's high because, I mean, when you look at what plunged us into the bear market territory on a closing basis, not for the S&P, but at least on an intraday basis, we can use that as a metric. But, it was the fact that we did have tariffs on basically everyone in the world, but also many sectors. But the second aspect of that was because they were so aggressive in nature. So we've dialed back the aggression, but you still have the tariff aspect. And now the market has to figure out how to price in something akin to maybe a 15% effective tariff rate, which I know that can change in 10 minutes. But as of now, you're looking at a double-digit tariff rate that is still pretty restrictive for many U.S. companies. So I think the bar is high because of that, but also because with the rebound that you've seen since the April 8th lows, the S&P 500's forward PE and many valuation metrics in addition to that have basically come back to cycle and all-time high. So there's just a little bit less juice to squeeze out of that multiple expansion fruit.
Okay. I had the investor Brad Gerstner of Altimeter on halftime earlier today. He said not time to hedge. He said time to get much more bullish, and he listed the reasons. I want you to watch this. We'll react on the other side.
We have the AI supercycle. We've seen a reacceleration in both the top line and the earnings. Oracle reported last night, blockbuster numbers. 80% of the S&P that reported all beat. The Mag 7 all beat and accelerated. And so I think that, so long as the government does these things that I describe, I think the economy's ready to cook. We have these rate cuts coming in the back half of the year. So I think that's the potential trifecta for this economy, an incredible pro-growth administration that is landing the plane on tariffs, that is landing the plane on the reconciliation bill, and we have rate cuts ahead. That caused us to get a lot more bullish at the beginning of May. We remain so today.
Why is that wrong, Ellen?
Look, for the reasons he listed, right, if all of those things come true, and he caveated it as well, then you are looking at a bull market that continue. I'm just much more comfortable in the entry point at 5,500 than I am at 6,000 plus.
But don't you think the things that he said are likely to come true? Like, you figure there's going to be, the president's going to declare victory on the trade war at some point, and tariffs are never going to be what they originally were when they were dialed back and started this whole move. We're going to get the BBB. The big beautiful bill passed.
Does the one big beautiful bill offset all of that? Is it enough to convince global investors that they can pull term premium down at the long end of the yield curve? Those are big ifs. Now, I do think there are some really interesting things here. I am a big bull on AI and coming productivity from AI. I am still very, very optimistic around defense and incorporating AI and tech into defense. And with the one big beautiful bill, what I'm most excited about are the investment incentives in it. Because I think as we roll into 2026, a narrative that I like is that the second derivative on growth, GDP growth, is not going to be driven by the consumer. It's going to be driven by infrastructure.
I think the other, and somewhat tied to that, the other big if that exists here is the labor market. If the labor market remains intact and you don't see some of these cracks start to widen in the second half of the year, even this morning, relatively stable jobless claims figure, but the continuing jobless claims number made another new cycle high. So that differential is just telling you that the rehiring rate is still really low. And it's not giving you any sort of Armageddon signal for the economy that you're starting to see some kind of spike in layoffs. But I think that coupled with now relatively restrictive immigration policy and the fact that we probably can't bake into any economic forecast just the assumption that you're going to get at least some sort of stable growth in the foreign-born labor population here. If that's not going to be the case moving forward, then you have downward pressure on labor force growth. And at its most basic level, the economic growth, the economy as it's growing is a function of productivity growth and labor force growth. So you need that productivity piece to really pick up and expand a lot more. And so I think that's why, to Ellen's point, going into 26, if that infrastructure spend and sort of productivity story is going to really expand, I think that's great and maybe plugs the gap from the labor perspective. But I think that labor becomes an ever more important part of the puzzle.